Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic, from basic to best: how to upgrade your Altruist solo 401k with my solo 401k financial. This is your chance to get answers. Please use the chat now to ask questions on today's topic or anything else. Again, please chat them over now so that we can be sure to get to them all. We'll jump in with the questions that were already chatted up. Thank you so much for your patience. First question's from Barry. If 70 and is rolling over all from my solo 401k financials Roth 401k to a Roth IRA, which form to use? Full or partial transfer of Roth solo 401k to Roth IRA. Doesn't want to close. So if doesn't want to close, please use partial. The full is for those that are closing, and that will lead into the wind down process, including filing the 5500 EZ. Great question. Next question from Bill. Glad to be a client of my solo 401k. Well, glad to have you. Thank you, Bill. Can you talk about the mechanics of the employer match? Is it as easy as just transferring funds from the business checking account to the designated solo 401k account? So first of all, thank you so much for the good question. Technically, with a solo 401k, one is not eligible to make a matching contribution. Matching contributions don't apply to a solo 401k. Instead, you make an employer profit sharing, or what they call a non-elective contribution. And these are generally made to the pre-tax account. So it can be the same pre-tax account into which one has made pre-tax employee contributions, or the same pre-tax account into which one rolls over pre-tax solo 401k funds, say from a former employer plan or a pre-tax IRA. As far as transferring the funds from a solo 401k perspective, it's totally acceptable to transfer the funds from a personal account or a business account. There's no requirement that it comes from one or the other. What's more important is that the contribution is made within the contribution limits, by the contribution deadline, and into the applicable account. Now, as far as making employer contributions as Roth contributions, technically that is now allowed per Secure Act 2.0, but based on client experience and feedback, it's generally not done with our clients. And the reason for that is that even though this was a new type of contribution that could be made, thanks to Secure Act 2.0, our clients were already able to make Mega Backdoor Roth contributions. And the way that you make Mega Backdoor Roth contributions is by making voluntary after-tax contributions. So with regards to the choice of making employer contributions as Roth contributions or as making Mega Backdoor Roth contributions, our clients almost always choose to make Mega Backdoor Roth contributions. They just skip making employer Roth contributions. And that's because, number one, you don't need as much self-employment income in order to be able to hit the contribution limits. And that's because the voluntary after-tax contribution limit is 100% of the self-employment compensation, dollar for dollar, up to the overall limit, of course, reduced by any other contributions made to the solo 401k plan, whereas the employer contribution limit is a percentage of the compensation. So one would need more self-employment income to justify the contribution if they make those contributions as employer contributions. The other reason, based on experience, that clients would simply skip making employer contributions as Roth contributions and instead make Mega Backdoor Roth contributions is that the reporting is more simple. So when you make an employer contribution as a Roth contribution, per the IRS notice that came out almost a year after the Secure Act 2.0 was enacted, per the IRS notice, employer contributions that are made as Roth contributions still need to be reported as tax deductible on the employer's return for the year for which the contribution is made, but then they're reported as taxable to the employee for the year for which the contribution is deposited. Whereas when you make an after-tax contribution, that doesn't need to be reported on the personal tax return or the business tax return. It doesn't need to be reported on the W-2. Only the second step, when you then move the funds from the voluntary after-tax contribution to the Roth account, either a Roth solo 401k or Roth IRA, only that second step needs to be reported on the Form 1099-R, which we handle as an optional free service for our customers. They just have to let us know when they do the transfer so we can capture the information that's needed to prepare the 1099-R. And that is an explanation of how you do an after-tax contribution or mega backdoor Roth contribution. It's that two-step process, after tax to Roth. So hopefully that helps. Great set of questions. Thanks so much for bringing it. Next question is from Matthew. I was a Washington State corporation with an S corp election. I've completed the conversion with the Secretary of State, moving to a single member LLC. Well, that must have been actually with the IRS if you're revoking the S corp status. It looks like. Well, if you converted from a corp to an LLC, that would be with the Secretary of State. But the S corp election, one would work with their tax advisor to revoke that with the Secretary, or excuse me, with the IRS. So the entities with the state, the tax elections with the IRS. Now I have no idea what my steps are to amend my solo 401k plan to deal with all this. Currently, with Fidelity, with their boilerplate solo 401k, can I engage your firm to handle my changes? So in short, yes, as long as you continue to be self-employed with no non-owner, non-spouse employees working for any business owned by you or a spouse, if any. In that case, you could choose to simply upgrade your solo 401k that you have through Fidelity to our plan. And the process is referred to as a restatement. So even for folks that are not changing how their self-employed business is being taxed or organized, they often will upgrade their basic plan at Fidelity to our plan to take advantage of the service and features of our plan, whether it's Mega Backdoor Roth, the $1,500 in tax credits, the ability to invest in alternative investments or take a 401k loan, etc. So as part of that upgrade process, we need to restate the plan documents, redraft the plan documents. So now they're drafted under our IRS approved plan documents. So when we redraft those plan documents, we can simply just list your new entity. So if you go to our website and click on open account and then solo 401k, it's a quick 1-minute application. Once you submit the application and make payment, we prepare the documents within the same business day. So when completing that information, you can just provide your current information as far as your business entity. You would indicate in response to the question that you already have a solo 401k at Fidelity. Provide the original plan effective date because we'll need that date to draft the restatement documents. You can find it on your adoption agreement, or you can send a secure message to Fidelity to get the information. Then we'll draft the restatement documents under your new entity with the new business type. We'll help you open up new accounts for the restated plan, which can be at Fidelity, and then help you transfer the assets and cash over from the pre-existing account to the new account for pre-tax solo 401k funds for your restated plan. So now the plan will be governed by your new entity, or I should say sponsored by your new entity. And moreover, you'll now have access to the more advanced features if you'd like to take advantage of those. Thank you for the good question. Next question is from Jack. I'm a current client. Thank you so much, Jack. I have a one-person S corp for my business. My spouse has a W-2 day job at a different company, and she's maxed out her 401k contribution there, pre-tax plus after-tax, for the total of 70,000. So she must have a 401k plan that allows her to make after-tax contributions. Now I plan to add her as an employee of my S corp, pay her $40,000 per year, and add her into my S corp solo 401k plan. My understanding is that my S corp can contribute 25% of her W-2 wages as an employer pre-tax contribution, and then she can contribute the difference as a voluntary after-tax contribution. Also, could she do the Mega Backdoor Roth for a $30,000 after-tax contribution? Does all this sound correct? Yes, it does, assuming that she's working in your business, which it sounds like she will be, and that her day job plan is not a 403b, it's a 401k. If yes, the employer contribution limit, which is 25% of the W-2 wages, plus the after-tax contribution limit, is not reduced by contributions made to a day job 401k plan, And yes, she can make that as a mega backdoor Roth contribution. So she would have three accounts. She would deposit her employer contribution to the pre-tax account. She would deposit her after-tax contribution to the after-tax account, and then move the funds from the after-tax solo 401k account to the Roth solo 401k account so they can start to be invested and grow on a potentially tax-free basis. However, I talked to my CPA today and she said my wife cannot contribute to the after tax since she has already maxed out her elected deferral at her day job. No, because the after tax contribution limit is the overall limit. So it's the 415C limit, and that limit applies at the plan level. So just like the employer contribution is not reduced by contributions made to a day job plan, so in other words, a plan sponsored by an unrelated employer, the after-tax contribution limit is not reduced by contributions made to a plan sponsored by an unrelated employer, like a day job plan. The only exception to that is the 403B exception. That's why I mentioned I understood that the day job plan is not a 403B. Another question from Jack. Thank you so much. Am I S Corp? Is my wife considered as self-employed? Yes, she is, as long as she's working in the business and reporting her own self-employment income, meaning she gets a W-2. She doesn't need to be an owner of the S corp. She needs to be your spouse and receive a W-2 in order to enable her to be able to participate in the plan and make contributions based on those W-2 wages that she receives from the S corp. Next question's from Ashley. Let's talk about the rule of 55. I left an employer in a year after I turned 55 so I can distribute funds penalty free without waiting for age 59 and a half. If I set up a solo 401k, is there a similar possibility there? If I stop being self-employed, I theoretically have left the employer. So yes, although it's rarely used because it would require you to stop being self-employed. So most folks don't want to just shut down their business. But yes, you could if you can not only if you are not only age 55 but also stop being self-employed. So exactly. However, could I do this without shutting down the company? No, because again, you'd have to stop being self-employed. That's a great question, and it highlights why it's virtually never done. Thank you for bringing it, Ashley. I've heard of something called the IRS step transaction rule. This is a question from Edward. When making an after-tax contribution followed by a Roth conversion the next day or two, would this cause problems with the step transaction rule? Typically, the step transaction rule refers to something totally different, which is in the prohibited transaction context. Essentially, the concept being that um, if someone wants to have a transaction between their 401k and a disqualified person, they will have the 401k transact with a non-disqualified person, and then the non-disqualified person as a second step transact with a disqualified person as a way to work around that prohibited transaction rule. So for example, you cannot buy assets from your 401k plan. You couldn't transfer money to your 401k plan and have it transfer an asset to you personally because the solo 401k owner is a disqualified person with regards to their solo 401k plan. And so someone might say, well, what if my 401k plan sells this asset to this other person over here, my neighbor, and then my neighbor sells it to me? Well, the IRS, under the step transaction rule, would ignore that initial step of selling it to your neighbor, and just analyze it as if the asset was sold directly to you. And, and under that step transaction rule analysis, that's prohibited because, again, the 401k can't sell an asset to you unless there's an exception under the statute uh, that applies to prohibited transactions. The prohibited transaction exception section of the statute. I am assuming there will be some interest left over in the after-tax account after the Roth conversion, so gains. Can I just leave that until the next year conversion? No, you can't, because when you transfer the after-tax funds, all the funds need to be transferred. Now, if those gains hit after the basis was first transferred, then yes, they could be left and then transferred later. Great questions. That's a great start. So if there's more questions, please don't hesitate to chat them over. Let's dive into some of the slides we wanted to share. And of course, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Right off the bat, if you could please take 1 second to like and subscribe. Liking tells the platform that the content is valuable, which helps other solopreneurs like you find it. So please like it if you're on one of the social channels like LinkedIn or X or YouTube or Instagram. Subscribing guarantees you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. Looks like we might have some trouble on Instagram, so sorry about that. Okay, so as far as the topic at hand, from basic to best, how to upgrade your solo 401k at Altruist with my solo 401k financial. Let's give a quick overview of where we're headed. So there are many individuals that start out with a basic plan at a brokerage, whether it's at Altruist or Fidelity or Schwab, and then they discover these more advanced features, or maybe they're now ready to take advantage of the more advanced features. So there is a way to upgrade that more basic plan to an advanced plan like the one offered by my solo 401k financial to be able to take advantage of those features, those benefits like the $1,500 in tax credits. So specifically at Altruist, they offer a solo 401k account type. So if someone opens up a solo 401k account at Altruist, it's going to be governed by their plan documents, which are not going to necessarily provide the advanced features like the Mega Backdoor Roth, the ability to take a 401k loan, tax credits, nor of course would we support that in terms of doing the 5500 EZ or the 1099R. But individuals can easily upgrade the documents. So you can think of it as a cut and paste, cut out the Altruist documents and replace them with our documents. So now they can take advantage of those more advanced features and the support, etc., but still have the investments at Altruist. So we want to talk about that process with these slides. Now, of course, the foundation is eligibility. So in order to be eligible, the individual needs to be self-employed with no non-owner, non-spouse employees. So you can think of it as two prongs. So one is self-employment, and that can be through an unincorporated entity. It could be a sole prop, or it could be an S corp or a C corp or a partnership. The key is reporting earned self-employment income. In the case of a sole prop, that's going to be income reported on Schedule C. Case of an S corp or a C corp, income reported on a W-2 from the S corp or a C corp. In the case of a partnership, income reported on line 14 of the K1 from the partnership. Now, the other prong is not having any full-time W-2 employees, but that doesn't include a spouse. So the key is a non-owner, non-spouse full-time W-2 employee. So that means that the self-employed person could have contractors working for them. Their spouse could be a W-2. They would still be eligible. They could even have employees, but they'd want to be super careful that those employees don't work on a full-time basis. The standard has gone down, right? So in order to be full-time, you either need to be working 1,000 hours a year with a year of service or 500 hours a year for 2 consecutive years. Ultimately, this can be ideal for consultants, freelancers, realtors, and other small business owners. So again, why upgrade to my solo 401k? Take advantage of those more advanced features. So Mega Backdoor Roth, $1,500 in tax credits, solo 401k loan feature, 5500 EZ filing support, 1099R distribution form support. These are some of the top features, at least for altruist advisors or other advisors, right? There's other features like the ability to invest in alternative investments, but based on experience, we don't necessarily see that with the advisor population. Reason number one to dig a little deeper is the Mega Backdoor Roth. So Mega Backdoor Roth is a marketing term. It's kind of like the industry term, and it comes, I would say, from the backdoor Roth IRA. So first, people understood the backdoor Roth IRA. Now there's more understanding of the Mega Backdoor Roth Solo 401k. So that term is helpful and harmful. It's helpful because, like a backdoor Roth IRA, you're making an after-tax contribution and then transferring it to a Roth IRA. But the rules that apply to backdoor Roth IRAs don't apply to Mega Backdoor Roth Solo 401ks. For example, the contribution limits are much higher, right? The pro rata rules are much easier to comply with because they just apply at the account level. So individuals can make Mega Backdoor Roth Solo 401k contributions and also make a backdoor Roth IRA contribution. The Mega Backdoor Roth contribution limit is much higher. You can contribute up to $70,000 or even more if you're age 50 or older for 2025. You can transfer just the after-tax funds in your solo 401k either to a Roth solo 401k or a Roth IRA, notwithstanding the fact that you've got pre-tax money or Roth funds in your solo 401k, as long as those after-tax funds are in a separate after-tax account. Because again, the way that the rules apply, the pro rata rules apply to a solo 401k is at the account level. That's why you need to have that separate after-tax account. Now, the foundation is you need to have a plan document that allows for Mega Backdoor Roth contributions. So if you have the Altruist basic plan, it's not going to support that. Whereas our plan does, it's automatically drafted to support both voluntary after-tax contributions and then the in-service transfer to a Roth account. So that is what a Mega Backdoor Roth contribution is. It's that two-step process, the after-tax contribution plus the in-service transfer to a Roth account. But you need to have the plan documents that allow it. So you could cut out the Altruist plan documents, replace them with our plan documents, and then be able to make those Mega Backdoor Roth contributions. Of course, you'll need new accounts, and we'll talk about that. But at least that's the foundation, is getting those documents in place. Now, other benefits of having our documents include the ability to take $1,500 in tax credits. And if the plan is upgraded to our plan or a new plan is set up here by December 31st of 2025, the self-employed individual would be eligible to start claiming $500 in tax credits for 3 years, starting with their 2025 tax return. And this is a tax credit, not a tax deduction. So it's more valuable than a tax deduction because it's a dollar for dollar reduction in their tax liability. In order to be eligible to claim the credits, though, it goes back to the documents. You need to have the documents that include the automatic enrollment feature and the other required notices. We automatically draft our documents to include those features. Now, as part of the feature, it's going to set a default 3% contribution percentage. But the solo 401k participant, as the employee, has the right to opt out of the default 3% contribution percentage. But that doesn't mean that the plan doesn't include the automatic enrollment feature. So the business would still be eligible to claim the credits, notwithstanding the fact that the individual opt out of the default 3% contribution percentage. And just opting out of the default 3% contribution percentage doesn't mean that they can't contribute. It just means that now they have maximum flexibility to make contributions in whichever percentage or schedule they prefer. Of course, as long as they do it within the contribution limits and by the contribution deadline. Reason number three to upgrade to our plan documents is access to a solo 401k loan. So in order to be able to take a 401k loan from your plan, you need to have the plan documents that allow for the solo 401k loan. And then the individual can withdraw the money and it's not going to be subject to taxes or penalties, provided that it's within the contribution limits, it's documented on solo 401k loan documents, and paid back according to the terms of the solo 401k loan. So we will handle that. We will handle those loan documents as an optional free service for our customers. We have a form on our website that clients or advisors will submit to prompt us to prepare the loan documents, and we do that within 24 business hours. The terms are that the individual can borrow up to 50% of the value of their account, not to exceed $50,000. The loan needs to be paid back in monthly or quarterly payments, equal payments of principal and interest. The interest is prime plus 1%, or you could use a CD rate plus 2%. with those payments spread over a 5-year term. Expert compliance support. So, of course, if the individual becomes our client, we provide the expert compliance support. That's going to include 5500 EZ filing as an optional free service. Clients of their advisors just need to let us know once the value exceeds $250,000. Then we'll add their plan to the queue to reach out to gather the information that's needed to prepare the 5500 EZ. So once the value of the plan, including all investments, accounts, even the value of any defined benefit plan that might be sponsored by the self-employed business, exceeds $250,000, there is an informational tax filing requirement. The name of that informational tax filing is referred to as a Form 5500 EZ. We will prepare it under the electronic filing system to make it easy for the customer. Form 1099-R. So this will apply when there are certain events that require a 1099-R, like a distribution, if funds are transferred out of the plan, a conversion, like a pre-tax to Roth or after-tax to Roth. So this would be required when one makes a Mega Backdoor Roth contribution. Because remember, a Mega Backdoor Roth contribution is a two-step process. First, it's an after-tax contribution. Then it's a transfer. It's a conversion to either a Roth Solo 401k or Roth IRA. So clients of their advisors will let us know about that transfer since we don't have access to the account. Just a quick 1-minute form on our website to give us the information we need to add the plan to the queue to prepare the 1099-R. And then we'll handle that as an optional free service. In other words, no additional charge. The restatement process, this is again upgrading the plan documents. So it all comes back to the documents. Now, common questions will be, okay, am I closing the plan and then starting a new one? No, you're continuing the same plan, but now it's governed by our plan documents that enable those advanced features. So because it's a continuation of the same plan, the restatement itself is not going to trigger a 5500 EZ. Now, of course, if that plan asset value is in excess of 5500 EZ, there will be a 5500 EZ filing requirement, but not because of the restatement, just because of the value. It won't trigger a 1099-R filing because the assets are not leaving the plan. New accounts do need to be established because the existing accounts at Altruist are those solo 401k accounts. That's the situation we're assuming here. A solo 401k account type was set up, governed by Altruist plan documents. Now those plan documents have been replaced with our plan documents. Altruist has a separate account type when the account is opened up for a third-party plan. So that new retirement trust account type would need to be opened, and then the cash and assets transferred from the pre-existing account to the new retirement trust account. So that transfer is not a 1099-R event because the assets are just transferring from one account to a new account for the same plan. There's no distribution, there's no conversion. Setup is fast and simple. You can just go to our website, mysolo401k.net, click on open account, then solo 401k, just takes 1 minute, submit payment. The documents will be sent within the same business day. Now we want to just take a moment to talk about the retirement trust account type. So just to highlight that, just some of the pitfalls. So you're not opening up a solo 401k account type because remember, those are account types where the account is governed by the basic plan document that doesn't include these features. And you're not opening a trust account type, even though a solo 401k is a trust. From Altruist's perspective, you want to choose the retirement trust account type. This is an account type that was created specifically by Altruist for third-party plans. Now, it's important to open up the account under the name and EIN number of the solo 401k. So we obtain an EIN number as part of the onboarding process specifically for the solo 401k. This lets the IRS know that this EIN number is associated with the retirement account. So in the event that there's any income reported under that EIN number, the IRS is going to understand that income is growing inside of a retirement account on a tax deferred basis. Now, as far as how many retirement trust accounts one would need, if there are multiple participants, let's say there's two spouses working in the same business, but both participating in that same solo 401k plan, each would have their own retirement trust account. Moreover, if there's going to be different types of funds like pre-tax, Roth, and voluntary after tax, Again, you need additional retirement trust accounts for each type. So, for example, if there are two spouses and they're both going to be making Mega Backdoor Roth contributions, there would be six accounts, a pre-tax, a Roth, and a voluntary after-tax for each. Individuals will typically just nickname the accounts to help keep track. Then, as far as funding those accounts, you could transfer the cash and assets over from the existing solo 401k account at Altruist to the new retirement trust account. Moreover, you can fund it by making contributions and or rolling over funds from an eligible retirement account, like a former employer plan or a non-Roth IRA. As far as making contributions, they don't have to be made through payroll. From a solo 401k perspective, it's totally acceptable if they're just simply transferred from the personal account or the business account. As far as tax reporting, per Altruist, no tax reporting is done from a plan perspective on these retirement trust accounts because they understand that these retirement trust accounts are created for a third party solo 401k plan, where we handle that as an optional free service for our customers. Now, they may do trading activity reporting like a 1099 DIV or a 1099B, but those will be issued under the EIN number that was used to establish the retirement trust account, which goes back to why it's important to use the EIN number that was obtained specifically for the solo 401k. So now when the IRS receives that, say, 1099 DIV, they understand that that income is growing inside of a 401k on a tax deferred basis. And just a quick comparison with solo 401k at Altruist versus a solo 401k through my solo 401k financial, but the accounts are at Altruist. It goes back again to those plan documents. So with our plan documents, it's going to allow for employer Roth contributions, Mega Backdoor Roth contributions, alternative investments, the $1,500 in solo 401k tax credits, and then of course the compliance support that we offer as an optional free service for our customers. Thanks so much as we went through those slides. Let's go back to the questions. We really appreciate it. And again, if you're finding this to be helpful, please like and subscribe on whatever social platform you're watching us on. It helps us to get the word out to others that might be interested in this topic. Thank you so much. So our next question is from AA. If I max my day job 401k and can still contribute 70,000 to my LLC solo 401k, is there a reason to just put it in all after tax versus splitting? Is it just a preference? The benefit of splitting seems to be loan access from the pre-tax portion since most Roth withdrawals are permanent. Is that right? So, well, as far as the reasons based on experience and client feedback, is that some may want to have a diversified approach from a tax perspective. In other words, make employer contributions as pre-tax contributions to reduce their taxable income for the year for which the contribution is made, but then make additional contributions as Mega Backdoor Roth contributions, where they'll have that potential for tax-free growth. Whereas others may be just 100% focused on, say, those Mega Backdoor Roth contributions. So that could be one reason to split. But as far as the loan reason, that's not a reason, because let's say that you make a contribution to the pre-tax as an employer, then you make a Mega Backdoor Roth contribution where you first deposit the funds into the after-tax account, but then move them over to the Roth solo 401k as opposed to a Roth IRA. So if they stay in that Roth solo 401k, you could still withdraw those as a loan as long as it's within the loan limits, paid back, documented, etc. So yes, you could take a loan from a Roth solo 401k. Good questions. So as far as the account setup process, I'm assuming we covered that based on the discussion of Altruist. Let me know if that doesn't cover it. But that would be a good video topic as well, just to probably refresh, even though we do have one that's out there. Let me know if you've got specific questions or if you want me to touch on that. Thank you so much for the good questions, AA. Back to Matthew. How streamlined is your process of converting a standard plan at Fidelity or Schwab to your advanced plan? I would say it's very streamlined just based on the fact that we've helped thousands and thousands of customers do it. So the specific process will depend on where the assets will ultimately end up at. It's always going to be that restatement process of restating the documents and then opening up new accounts and then transferring the cash and assets over from the pre-existing accounts to the new accounts. So if the new accounts are at the same place, if they're at Fidelity or at Schwab, then it'll be easy to just transfer the cash and assets over internally electronically. And we do prepare the paperwork to initiate that transfer. Yes, we are very hands-on. We've got tons of experience. I have a new LLC and I'm discussing with my accountant whether to file as a partnership versus a corporation. Must I lock in this decision before setting up a solo 401k with your company? No, you do not, because it's certainly possible and actually not uncommon that self-employed individuals will start out organized as one, say, tax type, or even may start out as a sole prop, and then they set up a formal legal entity. And so the plan documents would need to be updated at that point, but it would just be a document update. We wouldn't have to create new accounts or change your investments. The name of the plan would stay the same. The EIN number of the plan would stay the same. Now, we do charge a one-time fee of $300 because we have to prepare an amendment. We have to restate the documents, amend the documents to reflect the new entity. But as far as the process, it's just an administrative process, not an account or an investment change process. Hopefully that helps. Thank you so much for the wonderful participation. We definitely appreciate it. Please continue to engage. Looks like that's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here tomorrow with more crucial content to help you secure your retirement. Got another question pop in from Ashley. Thank you. More on the rule of 55. I want to roll over prior employer 401k funds to the solo 401k to gain investment control. Okay, that's a common use case. I'll lose the rule of 55 access by doing that. Yes, that is correct. I'd like to retain the rule of 55 access to those funds as a contingency option. So you would lose it. It is available under the solo 401k, but it's hardly used for the reasons discussed above. That's the only solution or resolution to the extent that you consider that a resolution. So you either leave the funds where they are, but don't have the investment flexibility, or you take the investment flexibility, but lose the rule of 55 flexibility. Unless you can reestablish it under the solo 401k, but can be difficult for the reasons discussed above. All right, wonderful, everyone. Thanks again for all the good participation. Until next time.